All right. Hello, everyone, and welcome back to the Weekly Rebalance. We got a fun episode for you. We're going to talk about the private credit market, in addition to doing our normal weekly update along with trivia at the end. So, Ethan, how you doing?
Doing pretty well. Can't complain. How are you doing, Nick?
I'm doing well. No
Doing a
complaints
lot
here.
better today. The market's up.
Yeah,
Makes me happy.
big time. Big time.
Not that I'm materialistic or anything, but at least I try not to be, but it does help when it's green.
Who said money can't buy happiness?
I
Guys didn't know what they were talking about.
think a couple of people have said that, but they're probably right. But we're in a good spot.
They're probably right, but that doesn't count for, stock gains.
Yeah,
Those
that's
do
right.
make me happy.
That's right. Yeah, S&P 500 new all-time high intraday today, right?
Mhm.
Nasdaq as well. Yeah, I don't think the Dow is quite at an all-time high, but it's definitely positive pretty nicely today. So really big reversal from the sell-off on Monday.
Yep. Yep. That was another one. I every weekend it seems that we have a headline about Iran and things might be falling apart on the peace deal. Maybe they're not. And, I think the first few headlines, I was watching that really closely, and I'd be opening crypto markets every 30 minutes on Sunday night, trying to get an idea of what the market was going to do the next day. And now I see the headlines on Sunday morning, and it's like, I mean, the market could rally tomorrow. We'll see.
Who knows?
Who
Yeah.
knows? Didn't rally on Monday, but we've certainly made up for it.
Yeah, certainly made up for it. And oil prices dropped drastically today as well with the news on the Iran deal.
Hmm.
Again, we'll see if it holds, but the underlying quality of earnings season has been really high though. I think we've
It
got
really
80
has.
yeah, I think we've got 85% of companies reporting now. And well, actually more than that. But most companies have beat earnings per share. I think it's been the highest beat rate since quarter two of 2021. So really, really strong earnings season. So that's driving stock gains for sure as well.
Yeah, no, it definitely is. And I mean, we got Disney earnings last night, right? I think this was one of the more interesting ones, especially we did that episode on the K-shaped economy not too long ago and the state of the US consumer and, revenues for Disney were up a notable amount, which I feel like is a pretty good metric of discretionary spending within the US. Um,
Definitely.
so I mean, finding that really interesting. I mean, they're obviously rallying really heavily on the news, but potentially some interesting insight into the consumer there. Maybe not the bottom portion of that, unfortunately, but at least parts of the market are holding up well, and discretionary spending in certain segments is continuing.
Definitely. It's in like you talked about, we covered the K-shaped economy, the upside and the downside a couple episodes ago. It's interesting looking at the Federal Reserve and their decisions. I thought their meeting last week was very, very interesting, mainly because
Yeah,
of the division there. And you can understand why they're so
yeah,
divided on the votes, because on one side, you've got great earnings, the consumer is spending, that type of stuff. But how much of that is potentially driven by the top 20%, and how much are the bottom 80% suffering with the higher than average inflation that we've seen the last, 7 years? I mean, I think since COVID, uh, you know, I mean, really since 2019, 2020, I mean, we're talking about baskets of normal goods for regular consumers are drastically more expensive, 20,
yeah.
25% more expensive for a lot of different goods. So you can see why they're divided and having trouble with what do we do? Do we cut? Do we raise rates? Do we stay steady? Which is obviously where they ended. But
Yeah.
challenging time to perceive exactly what the right path is for the Fed.
Definitely. And I mean, on top of that, you've got a transition going on right now. So, are they really going to issue a two-sided warning going into a new chair? Probably not. But yeah, four dissents, right? Uh, Pretty high
Yep.
number.
That was the highest since so the vote was 8-4, so 4 dissents, and that's the most dissents since October of 1992.
Yeah. Yeah. And I think three were higher, one was lower. There was
Right.
definitely one that was lower. We know
Yeah,
that.
one wanted cuts, three wanted, the three dissenters that I don't know that they were necessarily in favor of hikes, but the way that I read it, they were not in favor of the easing language
Yeah,
used in the statements.
that's fair. Yep, that's a good qualification there.
Yeah, but now the market's pricing no cuts through 2026. So we'll see how that change. Powell leaves May 15th, and Warsh should be taking over, and we'll see how that changes things, if at all. But his first public statements will be very fun and interesting to follow, and see how the market reacts to those statements as well.
Yep, no doubt.
Mhm.
No doubt. Well, I feel like that covers everything. We do a lot of talk about the general markets every week. Good week this week, so positive
Yeah,
news now. You want to transition into private credit?
yeah. The research of the week. I feel like it was only so much time could go by before we covered private credit.
Yep, got to do it at some point.
Yeah. So what are your thoughts on private credit? It's grown drastically over the last decade or 2 decades, really.
Yeah. Well, it's tough because where do we start?
Yeah. Well,
There's a
maybe
lot
let's
to
start
talk
with
about.
yeah, let's maybe start with what is it and how big is it? Because
Yeah.
I feel like most of our listeners are fairly familiar, but let's go through some of the details.
Yeah. No, absolutely. Well, you're 100% right. It has grown quite rapidly. Market size somewhere between $2 and $3 trillion, projected to grow pretty rapidly from here on out as well. Been a growing space. Also been a space that's been in the news a lot here recently over some concerns in the market, and we'll talk about those and whether we think they're overblown or not. Um, but basically, it's a debt instrument for earlier cycle companies, companies that probably wouldn't be able to get access to larger public debt markets. Uh, Tends to be floating rate debt and tends to offer about a 2% yield increase as opposed to high yield. Part of that you're getting is the liquidity premium that comes with private credit, and the majority of instruments, and kind of excluding interval funds, and we'll get into that later, that fun topic. But yeah, a little bit riskier. Floating rate debt tends to be earlier cycle companies get a little bit more yield as opposed to high yield for it.
Yeah. It was really started in 2008. Not that there wasn't private lending before 2008, but Basel III forced banks to hold more capital against their risky loans, especially for those middle market borrowers. Private credit was the solution. If you
Yep.
couldn't go to a bank, you couldn't go to the bond market. You go to private credit, and that's where all of this arose.
Yeah. And I'm sure we'll get into this later too, but I find it interesting how portions of the high yield market have kind of crept their way into private credit, where high yield uh, is seemingly becoming a little bit more high credit quality as some of these riskier assets and issuers that would have gone to high yield kind of go the private credit route over time. That's something we've talked about in the past, maybe not on the podcast, but um, how high yield has kind of had a little bit of a migration.
Yeah, definitely. Well, let's first talk about like why would somebody be interested in private credit? What's it exist for in the first place? Why wouldn't, we covered why a company might be interested in borrowing, but what are the positives? What's the upsides before we get into some of the cracks and the risks?
Yeah, I mean higher yield.
Yeah. Higher
Credit
yield
markets,
because of
that's all you
illiquidity,
need.
right? Yeah, so
Yeah.
you've got illiquidity,
Yep.
and now that's one of the negatives, right?
Mhm.
But the positive side of that is you should be receiving an illiquidity premium. So the hope is that these companies, these players like Ares, Apollo, Blackstone, Blue Owl, they're basically closing these big private credit deals where they're lending and getting an illiquidity premium. there's actually a strong fundamental company underneath, and they're lending to this middle market company, and they're charging, like you said, let's just call it 200 basis points of premium yield for the illiquidity. And that should, if you don't need liquidity, that should be great for the investor, right? And it has been in a lot of cases. There's been a lot of success in the private credit market. What's been coming into the news, and what we're, I guess, going to talk about now, is the risks and some of the issues when that's not the case. And there's actually more defaults hidden in this, because there's a lot less transparency. And that's where I think we go with private credit in the future. It's not that private credit is bad. There's a lot of news out there that's saying that private credit is bad. I think it's a very nuanced story. One side is great companies that are borrowing at a little bit of a premium, and the investors getting a premium. And then you have the other side, which you just mentioned, Nick, which is you're starting to see some cracks in there, because maybe there's so much capital flowing in there. Maybe we're lending to some less quality companies. Some of the funds are less disciplined in how they're distributing or investing in private credit. Some of the investors are less disciplined, and we have more and more defaults creeping into the mix here.
Yeah. Well, I think it comes at an interesting point for private credit as a whole. Like you said, mainly started back in 2008, or coming out of 2008. So, coming out of a pretty large recession, in a period of market stress. And since then, we had the COVID bubble, or COVID crisis, I guess. And then from there, we're coming to where we are today, starting to see some signs of stress in the economy, certain companies as well, especially some pretty notable private credit defaults last year. Not necessarily fund level, just specific companies that were notably represented in the private credit space. But, this is going to be potentially one of the first real stress cycles for this asset class, and especially one of the first stress cycles with more public funds within the space. Because one of the things we talked about a little bit earlier, interval funds have become really popular as a private credit instrument. And I think that's a great thing. It democratizes the access to the asset, and for the people that understand what's going on underneath the surface, I think it's a great way of accessing it. The problem is when the news starts talking about risks of default, concerns in that private credit market, and there's liquidity gates, can start to cause a little bit of panic in a market that is largely behaving the way that we would expect it to.
Yeah, for sure. Well, and like you said, Nick, you referenced that there's been some notable defaults within the private credit space, and that's the big question. The headline default rate is somewhere south of 2%, right?
Mhm.
But there's been an increase in what they call payment in kind loans, which are borrowers are paying interest by issuing more debt,
Yeah.
right? More private credit. And there's so much money flowing into private credit that it's looking for, or at least there has been, right? And they're issuing more debt instead of cash, which is a really good way to mask the stress, and a big warning sign. And the true default rate might be closer to about 5%, which is a huge difference and a major crack in the system. That's where you have, I think was it Jamie Dimon called it a cockroach. There's a cockroach in the private credit. And he could be right. I mean, he's one of the most informed people on the planet on these types of things, right? But that's the big debate nowadays is, well, what is the actual default rate? Have a lot of the high yield risk crept into private credit, where we're not properly pricing the risk of the loans defaulting over the coming years. And we haven't had it tested yet. We don't know what it looks like. We haven't gone into a real, deep recession since 2008. And that is gonna, if we do, hopefully we don't. We haven't, we're not in a recession now. Look at the earnings growth we're seeing now. But when that gets tested, that's the issue that everybody's afraid of.
Yep. And it's definitely a reason for concern. Like you said, that headline default rate that we're seeing is definitely not 100% representative of what's occurring beneath the surface for those reasons you talked about. So, um, there's definitely been some, reasons for concern. No doubt, no doubt about that.
Yeah, definitely. The other thing that I noticed that's a concern, or more of a concern, less of a concern, sorry, and more of just a negative moving forward, is there's so much capital chasing deals in private credit right now that yields are starting to come down. So the big reason why you invest in private credit in the first place is the liquidity premium, finding these
Mhm.
deals where good quality companies that are actually willing to pay a premium because they can't access the bond market for whatever reason, or they can't go to a traditional bank. Well, as capital chases those deals, the yields come down, and that illiquidity premium, which is the main reason to own private credit in the first place versus public credit, it's starting to narrow.
Yeah. Well, and on top of that, just talking about the addressable market, I mean, from what I'm seeing, again, these numbers aren't 100% perfect or anything like that, but really the private credit market is about the same size as the high yield market right now. They're kind of in a similar spot.
Right.
The high yield market's pretty mature. It's been around for a while. Um, so I find that interesting and, wondering as more money piles into it, access to 401k plans is one of those things that's been talked about for these more illiquid products. Um, like you mentioned, we've got a lot of money coming in here. How many deals can be made? How much capital can actually be allocated before the benefit's gone?
Yeah. Yeah, exactly. Well, that's gonna, again, it's a good reminder that this market is a developing market and it's changing a lot. It's changed a lot over the last, decade and a half, and it's probably going to change a lot over the next decade to decade and a half, especially whenever we do get to a deeper, more challenging recession, which, you know, I guess we all hope that doesn't happen, but it's inevitable. It will happen at some point, whether it's 2 years from now or 5 years from now or 20 years from now. It will happen at some point. And this is going to be a market that's going to be tested significantly. And hopefully it's up for the challenge, but it hasn't been tested before. Not in the way that most markets have been. Like you're mentioning, the high yield market's been around forever. The investment grade credit around forever. Equities around for this is just, it's a new market. We don't know, and there's so much capital that's flowed into it, and we don't know what that looks like when we go through a stressful environment, whenever that does happen.
Yeah. Yeah. Well, I think we kind of addressed that. There's definitely some reasons for concern out there. Not necessarily a need for panic or anything like that, but definitely some causes for concern. What do you think about the mixing of, and I guess this kind of broadly ties to private credit, private equity, the mixing of, I guess, liquid investment vehicles or more liquid investment vehicles with these more illiquid asset classes and how that impacts um, how they're perceived in the market in general. But also, is that something that's like compatible? Um, do those two things like really work together long term?
Do you mean like a liquid vehicle,
Yeah,
like a
let's
go
say
ahead, sorry,
interval fund.
an interval fund? Yeah.
Yeah,
So you got liquidity, some liquidity. There, you're trying to introduce some liquidity into the market. Yeah.
yeah,
What's similar with it, similar question could be raised for private equity. There
yeah,
are now liquid, publicly traded, exchange traded funds that are investing in private markets. It's a mismatch from my perspective. Not that things turn out great when the market's going up and to the right and there's lots of money flowing around. But I mean, again, that's why with interval funds, for example, in private credit, you have the ability to cap the withdrawal rates,
yep.
which is needed in a private space like this. And it's from my perspective, they're not the, I don't know. I think there can be, I think it's a nice way for investors to get easy access to these type of these type of products. But again, like you mentioned earlier in the podcast, a lot of investors that are using these vehicles don't understand exactly what they're getting into. If you understand what you're getting into and understand that there is true illiquidity, you're using a liquid investment to get access to it, to a illiquid. And really what their the biggest feature that I think they're providing is lower minimums to get into the portfolio, where you couldn't do that if you're going direct. That's a big that's a positive. But I think there's the potential that a lot of investors don't understand the actual risks and not realizing they really can't get out of that position for a long time. And that's the biggest concern I think I have when you're trying to mix these illiquid vehicles with liquid products. It's just there's a mismatch, and it lends to potentially a big misunderstanding from the actual users of those products versus the traditional users of those products that have been more educated about those type of things.
No, I think that's 100% right. I mean, overall, in theory, I think it's a great thing. And overall, I think it's a great thing. But like you said, you have a high potential for misunderstanding. And I think a lot of the reason why this go around with private credit concerns has been so covered in the news recently is, we've got these interval funds that are capping redemptions now. Typically it's 5% a quarter. And they've been hitting those caps and actually exercising them. And so you've got a number of clients going, hey, what do you mean I can't get my money now? I thought this thing was liquid. I think that just kind of tends to amplify concerns when maybe the investment, it's a riskier investment. That's just one of the things that you have to understand. That's why you're getting that increase in yield. That's part of why you're getting that increase in yield. So, when it starts to do riskier investment things, when the economy's struggling a little bit, or there's some other issues that you've got going on, and you have people realizing that, oh, this thing isn't 100% liquid, can't get all of it out, they're exercising the gates, then it starts to cause some concerns that maybe aren't emblematic of an issue with the product itself or the underlying, just maybe a misunderstanding with the people who purchased it before going into owning it.
Yeah, exactly. I think that's the big risk, because overall it's a positive, right? I am in favor of democratizing access to investments that have been largely locked up for the highest net worth individuals for some time. But understanding it is extremely important. And if you don't understand it, that's our job as portfolio managers, the job of the investment advisors. It's to educate people in those things before they enter them, so that we can have good outcomes. Because if there's misunderstandings, especially with something complex like that, the risks are much greater. Very hard to unwind a private credit investment, even in an interval fund or something that provides some liquidity, different than maybe a totally private credit option. But still very hard to unwind and can be confusing for lots of investors.
Definitely. Yeah. Yeah.
We'll follow. Totally we'll follow back up. This is a, like we said, a developing story, but it's one that's going to develop over the next probably decade. So we'll probably have to come back to this multiple times over the years.
Oh yeah, definitely, and especially as people start potentially getting into their 401ks directly, they're managing, purchasing funds within.
Right.
Definitely will add some interesting elements to the story.
Yes, sir. Well, should we wrap with some trivia?
Let's do it. I've only got one.
I've only got one as well, because I gave away all my others in our in the podcast already.
Sounds good. All good. All good. Let's see. Mine is goofy.
Let's hear it.
Do you want to? Okay. All right. Let's see here. All right. Here you go. Which prints more physical money each year? The U.S. Bureau of Engraving and Printing, printer of US dollar bills, or Hasbro, the company behind Monopoly?
I'm gonna guess the U.S.
No,
Um,
actually, no. I guess that could have been funny in a dark way or just funny.
I was thinking you were being so. Well, that's a good sign. I feel
I
good
know.
about that.
Well, if we were printing the amount that Monopoly prints, according to this article that I'm seeing here, we'd be in trouble because it says Monopoly prints around $30 billion in Monopoly money annually.
I didn't. How many
US.
people are buying Monopoly? It hasn't been
See,
around
this is
forever.
why I was trying to make sure that this is legit, and who knows, maybe someone will prove this wrong out there, but it seems like that's the actual number. There was a CNBC article that came out following one of the big anniversaries for Monopoly, and it said that they print about $30 billion in Monopoly money each year.
Okay.
Um, I don't know who's buying all those Monopoly sets. You know, they make those novel like themed ones, and maybe there's people like, I've got to get the, I don't know,
Yeah.
special edition Monopoly.
Maybe. I mean, I've got one Monopoly board, and I'm pretty sure it's like 30 years old. I'm not going out and buying the new one
I mean, it's
every
Hasbro. They
year.
probably print other fake money. I don't know if that's getting lumped in there, but it seems
Maybe.
like a lot. I mean, I don't know how much comes in the average Monopoly set, and it probably depends on,
Yeah.
whether it's set in the future or whatever. But
Yeah. That's funny.
yeah,
All
$30
right.
billion.
Well,
dollars. We got a lot of catching up to do.
that's good. That's good news. I don't
Yes.
want to print too much money. All right. Well, mine is specific to private credit. So let's see if you can guess this. It's one of the major players. So, what major alternative asset manager formed the Atlas Structured Products platform after acquiring Credit Suisse's Structured Product Group in 2023?
Oh, um, it's Atlas.
Mm-hmm.
Shoot, I'm thinking we've got like Aries, we've got Blue Owl, Cliff Waters. Yeah, I'm deciding between Atlas and Blue Owl. I'll say Blue Owl.
Ooh, that was a good guess, but it was unfortunately incorrect.
Uh,
Um, it was Apollo. Apollo.
the other A.
Yep, that was the other. It had to be one of those two or three, though.
Oh yeah, yeah,
Blackstone would
yeah.
be
I mean,
another good
there's
guess.
only so many players in the space. Yeah, Apollo. That makes sense.
Yeah, Apollo. My other questions were much better, but I gave them away already. So I'm
Yeah,
sorry.
I've stopped trying to come up with ones that are related to our topic because I end up giving them away.
I should stop doing that too because I give them away
But then
just
you
about
end up
every
with
week.
random questions about like how much money they print for Monopoly a year.
That's funny. Well, you got any other closing thoughts, Nick?
Nope. Nope. That's it for me.
Me neither. Well, we'll be back next week then.
All right. Thanks, everyone.
Thanks, everybody. Thanks, Nick.
Bye.